He was worth over $30 million, at least on paper. But when a big tax bill arrived, he didn't have the cash to pay it. Most of his money was tied up in his company's shares. The deal to sell his business was still in progress. Most of the money was delayed or locked in an escrow account. This is a familiar problem for wealthy founders and business owners. Wealth is often concentrated, illiquid, and tied to milestones outside your control. The IRS, however, doesn't adjust its calendar. Estimated quarterly payments, state obligations, and transaction-driven taxes arrive whether or not the liquidity has cleared. He had a choice: sell more shares and trigger a tax bill, take a loan from a bank at a high interest rate with personal guarantees, or take a loan from his own company. That's what he did. Let's look at how and why that can work. Let's break down how some wealthy business owners manage cash when most of their wealth isn't liquid. If you own a company, even 100% of it, that company is still its own legal entity. It's not you. That means your company can do things for you, like pay you a salary or a dividend. But under the right conditions, it can also lend you money. This kind of loan is called a shareholder loan or executive loan. And when done properly, it doesn't count as income, at least not right away. But properly matters. The loan needs to be written down in a legal agreement, a promissory note, charged with a fair interest rate based on what banks would charge, paid back on a clear schedule, backed by some kind of security like shares or assets, treated seriously, not just pretend debt. If those rules aren't followed, tax authorities like the IRS may say the loan was really a bonus or a dividend. Then you could owe taxes and penalties. Why go through all this? Because taking cash out of a company usually creates tax. Salary is taxed as regular income, up to 37% federal. Dividends can be taxed twice, once at the company level, again when you receive them. Selling shares triggers capital gains tax, usually 20% plus other charges. A properly set up loan, however, might allow you to use money now and pay tax later when you actually earn or sell. That's a big deal when timing matters. For someone in the middle of an acquisition, a loan can bridge the gap between deal signing and final payout. For a family business owner facing estate tax obligations, it can be the difference between keeping the company intact or selling assets under pressure. If you want more quiet, strategic breakdowns like this, hit the subscribe button. We explain what wealthy families are actually doing behind the scenes, without the noise. Let's look at where this shows up in real life. In private equity deals, companies sometimes raise debt and lend part of it to the owners. It's a way of taking chips off the table before an exit. In tech startups, founders use company loans to cover taxes triggered by exercising stock options or RSUs before the company goes public. Without it, they'd be forced to sell equity prematurely. In family businesses, loans are used to give one sibling liquidity, maybe to buy a house or cover education, without triggering unfair tax treatment compared to other heirs. These are not shortcuts. They're carefully structured parts of broader wealth plans, and they're only effective when the company is healthy, has surplus cash, and can withstand scrutiny. But not all companies can do this. For example, single-member LLCs. These are treated as the same person as the owner for tax. A loan to yourself doesn't create separation. S corporations. Loans require extra care. Missteps around basis, your ownership value, can collapse the tax treatment. Thinly capitalized businesses. Taking a loan from a company that can barely cover its obligations risks creditors, lawsuits, or bankruptcy claims. The structure only works when the company is strong enough to stand on its own and keep clear records. Back to our founder. He needed $1.2 million to pay taxes, so he arranged a loan from his C Corp, a regular corporation. The deal included a written contract, 3.25% interest, matching the government's required minimum, quarterly payments over 4 years, security backed by his shares. 6 months later, when his earnout arrived, he paid it back with interest. No salary, no share sale, no dividend. Just disciplined use of what his company could do, legally and carefully. Here's the real message. This isn't about avoiding tax. It's about managing timing and control. Most wealthy people don't live off of their salary alone. They control when and how they take income. A shareholder loan is one of the tools that helps with that when used correctly. It doesn't erase tax. It defers it sometimes to a moment when the cash flow, valuation, or family dynamics make more sense. Consider this. A family business worth $50 million faces an estate tax bill of nearly $20 million when the patriarch passes away. Without liquidity, the heirs might be forced to sell the business. But if the company has already established a disciplined shareholder loan structure, the business itself can finance the obligation, keeping ownership intact. Or take a founder juggling multiple advisory firms, each with partial information about his wealth. A loan can create immediate liquidity while he reorganizes the bigger picture, without triggering taxable sales that complicate the already fragmented advice. The lesson is clear. Liquidity isn't just about money, it's about control. Because smart modern wealth means looking at how wealth works in the real world, how people structure ownership, access cash, and protect control. This isn't financial advice. It's a look at what some high net worth entrepreneurs and families already do, within the rules and with the right setup. You've just seen how to strategically access capital from your company without triggering immediate tax consequences. But here's what keeps wealthy business owners up at night. Once you've moved that money, how do you protect it? Because taking a loan from your company creates a paper trail. It's documented, visible, and if you haven't built the right legal barriers around both your company and personal assets, you've just created a roadmap for creditors. That's where asset protection comes in. Some families use domestic asset protection trusts. Others rely on LLC layering, captive insurance, or even private placement life insurance. The goal isn't secrecy, it's autonomy, protecting liquidity once it's in your hands. Watch this video now to see the 5 protection strategies that sophisticated families use to lock down their wealth, and the single missing clause that cost one investor $3.8 million.